What are the key terms in options trading explained simply? Imagine you're at a market, and instead of buying fruits outright, you get a special ticket that lets you buy or sell them later at a fixed price. That's kind of how options trading works. It's all about contracts that give you certain rights, but not obligations, to buy or sell commodities like gold, oil, or wheat at set prices within specific times. Knowing the key terms helps you understand how to use these contracts wisely. First, there are call options. Think of a call option as a ticket that lets you buy a commodity at a certain price before the ticket expires. You buy calls if you believe the price of the commodity will go up. Then, there are put options. These are like tickets that give you the right to sell a commodity at a set price before the expiration date. Puts are useful if you think prices will fall or if you want to protect your current holdings from dropping in value. The strike price, also called the exercise price, is the fixed price at which you can buy or sell the commodity if you decide to exercise your option. The expiration date is the last day you can use your option. After that, the contract is no longer valid. The premium is what you pay upfront to buy the option. Think of it as the cost of your ticket. If the option expires without being exercised, this premium is your maximum loss. Options can be into money, out of the money, or at the money. If a call option is into money, the current market price of the commodity is higher than the strike price. For a put, it's when the market price is lower than the strike price. Out of the money options have no intrinsic value because exercising them wouldn't be profitable right now. At the money means the market price is about the same as the strike price. Intrinsic value is the real profit you'd get if you exercise the option immediately. It's the difference between the market price and the strike price when the option is into money. Time value is the extra amount you pay above intrinsic value, which reflects the chance the option could become profitable before it expires. When you buy an option, you hold a long position. This means you have the right to exercise the contract. If you sell or write an option, you take a short position, which means you might have to fulfill the contract if the buyer exercises it. Exercising the option is simply using your right to buy or sell at the strike price. Assignment happens when the seller is notified that the buyer has exercised the option, so they must fulfill the contract. Volatility measures how much the commodity's price jumps around. Higher volatility usually means higher premiums because the risk of big price swings increases. Open interest is the total number of options, contracts that are still active for a specific strike price and expiration date. Contract size refers to how much of the commodity each option covers, often around 100 units. In commodity investing, options give you tools to protect against price drops or to try to profit from price increases with limited risk. For example, a farmer might buy put options to guard against falling crop prices, while a trader might buy call options to benefit from rising oil or gold prices. Understanding these terms helps you evaluate strategies, manage risks, and make smarter decisions in the commodities market.